3, 2. And good morning. We will call this meeting to order. It is 10:02. Ms. Dix, will you please call the roll?
Absolutely. Dr. Ellis,
Here.
Mr. Hickman, present. Cliff Thomas, not present. Brad Wright.
Here.
Jim Stanislaus,
Present.
Aaron Kinsey,
Here.
Commissioner Buckingham, here. Tom Mayer,
Here.
Marisa Perez, not present yet.
We have a few missing, and hopefully we'll have a few come in, but we do have a forum. We are also joined by our NEPC representative, Brett Humphreys, fiduciary consultant for here with Stu Bohart, the chief investment officer, Jared Scott, manager of director of risk, Bob Gordon, Ms. Dix, John Newell, Chuck Campbell, our fiduciary counsel, and Errol Sloan with the office of general counsel. And welcome. And with that, we'll go to our first item of business, and that is the minutes of the February 20th meeting. Include those as part of your agenda. Are there any additions or corrections to the minutes? Is there a motion to adopt the minutes? Good. A motion and a second? Okay. Any additions or corrections? If not, minutes stand approved as read. Our next item on the agenda is the report of our Chief Executive Officer, Bob Gordon. Bob has welcome back to Austin, Bob. Yeah.
Thank you, Mr. Chairman. Good morning, members of the committee. I want to give you some highlights of our progress on our strategic plan since the last we met. And I'll start with some performance highlights over the last year. I'm going to page 10 right now. Delegate we have a 4.65% total return versus a benchmark of 4.16 for an outperformance of just at 0.5% for the trailing year. Our improvement in our performance relative to our peers has been significant. On page 11, you can see how once we've made some of the asset allocation changes that we've adopted and started migrating our asset mix towards those new targets, that combined with the manager alpha generating returns, we have seen an immediate and sharp improvement in our relative peer group rankings over the last year. The markets as of late have been extremely volatile. After the so-called Liberation Day, the announcement of tariffs kind of caught the markets by surprise in terms of the magnitude of the tariffs and the depth and breadth of them. There's been a lot of volatility. There's some one-day sell-offs and then one-day gains that are on the order of magnitude we haven't seen since the early days of the pandemic or the great financial crisis. That uncertainty is continuing as Washington's policy announcements are rather unpredictable right now, and the markets crave predictability. I think markets can quickly digest bad news and move on, but it's uncertainty that kind of really drives volatility. We expect that to probably continue throughout the summer as we work through large policy issues in Washington, particularly budget and deficit spending issues. This resulted recently in Moody's being the third final rating agency that downgraded the federal debt from the coveted AAA rating to AA1. Our portfolio, though, has been positioned somewhat defensively. In the fall, as a result of rates having come way down and credit spreads coming in very tight, we moved to shorten our duration in our fixed income book. We moved to take some gains off in the high yield and credit spreads, moving those things to cash. We also moved about 20% of our equity portfolio into equal weighted strategies instead of cap weighted strategies as a way to dilute the concentration in the Mag 7 stocks that we felt were approaching overvaluation. And lastly, we have rotated about $500 million of our equity portfolio domestically to developed markets, primarily Europe, to have a little bit more balance in our global diversification. All along, we've just been systematically building liquidity. We've got a lot of capital calls down the road that we want to make sure we've got the liquidity for. We also want to be positioned that we can be opportunistic in times of dislocation. So that's the basic positioning of the portfolio. In non-investment news updates about our fund, I'm happy to say that our legislative appropriations request has now gone through both Senate Finance, and the floor of the Senate was referred to the House, went through House Appropriations Committee, and the House floor as approved by this board. So we look to be in good shape to get the appropriations we've requested. Of course, we won't finalize that until the governor has signed such. I'm proud to say that Moody's also looked at the PSF again recently and reaffirmed our AAA status with a stable outlook. With an item of note, there's 3 kind of promulgations, both legislatively and executive orders relating to China. Because this board had moved to eliminate its emerging markets exposures over a year ago, we had long sold the liquid holdings in China. We do have some private equity holdings in China that, similar to the rules promulgated around energy boycott kind of companies, we are allowed to use the prudent person rule to let those positions run off. We've also made policy adjustments on any kind of contracting, travel, gifts, anything related to the People's Republic of China. So we're in full compliance with those promulgations. Other items in the legislature, Senate Bill 1903 has been referred off the Senate floor to the House, and it's referred to the House Public Education Committee. Has not been scheduled hearing yet. Proxy voting bill, Senate Bill 312. It's still pending, but however, I think both in its scope didn't apply to us directly at that time, but because of the moves that this board made a year ago in really overhauling our proxy voting to this, ESG skeptic kind of framework, we were kind of ahead of the game there in compliance for that. Anyway, one reporting requirement for the bond guarantee program that we have to report and post any downgrades of bonds. We are constantly monitoring that portfolio already, so this is just simply a reporting requirement that we'll have to add to that. In terms of volumes of commitments in so far this year, we've done a total of 18 deals totaling $3.6 billion across all of our private markets asset classes, from private equity to real estate debt. The 18 deals, 7 of them were new managers. 4 of them are Texas based managers, and 3 were emerging managers. So that's how that's spreading out. The rest of my comments will follow the strategic plan in terms of our progress there. On the first goal of updating our portfolio implementation, we are revising the way we look at risk to include all of our assets, including the oil and gas royalties program, so we can understand, our exposure to commodities and how that fits in with the rest of our portfolio. We've established a standalone performance and analytics risk committee in order to give more time and effort and resource to understanding and peeling the onion, so to speak, on our performance of our portfolio. Our future steps in this goal are implementing an overlay program to allow for much more efficient rebalancing and managing asset allocation tilts in a very cost-effective way. We're on the precipice of finalizing and centralizing a foreign exchange netting program. Historically, individual managers could run their currency positions individually, but we had a lot of situations where we may have been offsetting trades instead of netting trades. So now we're aggregating all of that. Should be much more efficient. We think we'll save $4 to $5 million a year in implementation costs. Lastly, we're going to be rationalizing the integration of our long public equity with our long short public equities in terms of just how we integrate the operations there. And our goal of attracting, developing, and retaining talent, we've now hired a new general counsel. We've added resources to the private credit team. We're in late stages of a chief operations officer search and early stages of a controller search. So we are very active in filling out some of these key positions here. I hope by the time we meet again in August, I can announce all of these as filled. We have launched our training programs now. This is kind of the developing and retaining.
Executing auto takes the dictation.
Our training is going to center in two silos: technical training and professional training. We've already launched the first series of technical training in Excel 1, 2, and 3, PowerPoint 1, 2, and 3, presentation skills, Copilot, which is an AI application. And we are laying out the curriculum and schedules for our professional training, which will be supervisory skills, management skills, leadership, executive coaching, team building, etc. We have brought in a couple of nationally recognized organizational design consultants to help us lay out and rationalize all of our finance and operations protocols, kind of on a whiteboard type of a method. And then we are overlaying what systems and resources we currently have that can support that and what we need to add to support that. This will kind of finalize the overall organization. We spent a structure. We started obviously with investments, and we built on audit capabilities. We've now addressed the legal team. So the last area that we're really scrutinizing is the finance and operations piece. And when we're done with that, we will have gone system-wide through all of our organization. Part of our recruiting is a much more active internship outreach. We have been very active in reaching out to universities in the state to recruit interns. We are onboarding our largest internship program in our history, including retaining some interns year-round, part-time. We've got a new kind of boot camp that we're putting all of the interns through. We're working on a cross-training program with interns and job swapping with some of our strategic partners. And we're going to be hosting an internship networking event here at Innovation Tower soon. And we'll continue to roll these out to more and more schools across the state and across the country, indeed. We have representatives and staff that have been tagged for certain flagship universities to develop that. And the communications goal, hope you all have noticed that we implemented this monthly newsletter and smoke signals to give you all some updates of activities intra-quarter. We have just posted our now in performance reports to Diligent, to the board members' libraries. We'll do that every month. We've updated the annual update to our investment guidelines, also posted to your library on Diligent. It was installed a mapping application. I'll show you in a moment. Our LinkedIn followers is up 300% as a result of many things, one of which is we are holding town halls with some of our more noted strategic partners. Executive management comes in, is willing to spend time with us. We're holding those meetings now in a town hall format with all employees. We will find a mechanism to capture that, record that, so board members can watch that as well. Some very interesting and useful things being brought to bear there. The same thing we're doing with this smoke signals newsletter. We've got a similar effort. We're going to do quarterly communications with SPOE to let them know what we're doing. This shows just a sample of the mapping software we have. We picked the bond guarantee program as just a nice visual. What you can see is we've plotted each bond across the state. These little blue dots are the individual bonds and what schools they're backing, The size of the blue dot is the aggregate dollar amounts. We've also overlaid that by SBOE district. And the shading in the color, which goes from tan to maroon, is indicative of the concentration of dollar amounts within the SBOE district. That concludes my comments.
Okay, questions? Questions from the board? Okay. No questions? All right. Thank you, and thank you for the staff for all the good work. It just seems like with every quarter, and we're continuing to move the ball down the field. And just, I think that you used the term that we were established in 1845, but we're in very much kind of a startup. And so, just in terms of reworking this and rebuilding this and building out the organization, and thank you for your leadership on that. So. Next, I'm going to go to Rhett Humphreys. Rhett is our fiduciary consultant with NEPC, and NEPC has been with the Public School Fund since 2009. NEPC is one of the foremost fiduciary consultants in the country. They've got a huge research team. They are the expertise, that is provided to this board. It's my understanding that NEPC has, in total, the aggregate assets under management are somewhere around $2 trillion across the country and around the world. And so I've asked him to bring some of his perspective just in terms of market conditions and kind of how you see the posture of the permanent school fund and the condition of the portfolio and where things are trending. And with that, welcome back to Austin from Atlanta, Rhett Humphreys.
Well, thank you. Yeah, I guess 16 years, a little older, a little slower, but hopefully a little wiser too along the way. So a few things, just the chairman asked me to make some comments on the markets, what we saw in the first quarter, and I guess what's ensued since then. So a few observations just on the equity markets, sort of the rate credit markets, and really what was sort of driving both of those, volatility and currency changes. So I'll update you on a few of those. First, starting with the equities. If you just follow the first quarter itself, there was a rotation there between U.S. and international that we hadn't seen in quite a while. U.S. equities, depending on how you were measuring them, down 4.5% to 9%, large cap, small cap. But at the same time, while they were going down in a global equity portfolio, we saw international emerging markets up, almost completely offsetting that, which was something we hadn't seen in a while. Well, sort of what was driving that and different things. But one of the pressing issues was currency, U.S. dollars. So those that don't follow this every day, if you're holding foreign assets, like you do in some cases, and the dollar depreciates relative to those foreign assets, when you translate those back for performance purposes, that's a performance gain. The dollar went down, foreign assets essentially went up relative to that. And so the dollar depreciating in the first quarter, you did see gains there. When I say depreciate, so a few numbers just to get your mind wrapped around. Relative to the euro, the yen, it was down 4.5% to 5% or so. That's not insignificant in 3 months. The standout, it was down relative to the peso, maybe 1.5% or so. But the standout for those that hadn't been tracking this or following it was the Russian ruble. So if you look down at just the U.S. dollar relative to all the major currencies in the world, you'd see, these 3s, 4s, 5% that I'm telling you about, and you'd just see the ruble at like 30%. Russian ruble appreciated. The U.S. dollar depreciated relative to the ruble by 30% in 3 months. And so sort of what it gives on that is a few things, because currency trading, it's a supply and demand. It's a trading issue. So what was going on? Well, global currency traders, they hate inflation and they love yield. And they don't like uncertainty either. Well, with the war in Ukraine, obviously there've been a lot of assets that have come out. Well, there seemed to be an inflection point in the first quarter of the year, new administration. Maybe there will be a change. Maybe there was light in the tunnel from war. So that was part of it. The other part was the impending tariffs here, which are inflationary, or at least that's the textbook view. Global currency traders were looking at that. At the same time, in Russia, if you think we were struggling with high interest rates and inflation here, just in the first quarter, their inflation rate was like 10%. And their administered rate, so their federal funds rate, ours is 4.5%, theirs was 21%. still is. And so thinking, going back to global currency traders wanting yield and running away from inflation, and things sort of seemingly calmed down there, began to move back into the ruble. And that's really what was driving that. Now, that didn't drive all of the changes in the international equity emerging markets because Russia's been pulled out of that emerging market index. But it gives you a sense of just how much volatility had changed in these currency markets in 90 days. So that is a lead into volatility. A few things on, if you watch this or see it, if you haven't really studied it, the VIX index, the VIX, the so-called fear gauge of the equity market. If you're watching Bloomberg or if you're watching one of the financial shows, and you'll see it down here, the VIX with a number. And that number itself, I guess the units of that would be percent, the type of standard deviation in a sense. And for those that don't sort of track it every day, I'll give you some context here. You can go back on with. So you think about, when we do asset allocation and we're forecasting for you guys and our clients, say the S&P 500, if we looked back in time, the volatility, the standard deviation on the large cap U.S. equity markets, usually around 17%. That's a standard deviation long term. Our current forecast on the S&P 500 is about 17% over the next 10 years. So now you take that and you look at the VIX index. It's generally, when things are calm and sedate, somewhere in the teens, and that 17 to sort of 20 range, and it can go much higher than that. What you saw in the first quarter, mid-February, the VIX index was like 15 or so. By Liberation Day, the VIX had moved to like 52. That's a 52% point standard deviation. Again, getting back to your bell curve math, if our forecast on the S&P 500 is 7%, and I'm telling you the VIX right now, their expected risk in the next 30 days is 50, that's 7 plus or minus 50, one standard deviation. So that's not a kind of risk that we see often. In fact, when I say we don't see often, if you track, the VIX came out, I think, in the early 90s, 1993 or so. If you go all the way back in time and just plot it, there have only been 3 instances of closing prices where the VIX crossed 50 percentage points, other than Liberation Day in April. Time before that was October 31st in 2008, leading into the great financial crisis, over 50. And then the time before that was, the time after that would have been the global pandemic, which was in February, I think it was February 28, 29 of 2020. It went over 50. So those are the times, the great financial crisis and a global pandemic where we didn't know Liberation Day. So the good news on that wild volatility is since then, this was a war was over 52. Since then, it has come steadily back. You can look it up on your phone if you have the app. You can watch it, on any of the financial news. But it is steadily tracked right back to below 20, which would suggest, at least in the very near term, a sense of certainty. There's not an expectation of price volatility, at least in the next 30 to 60 days or so. So with that, the volatility coming back in like that, naturally there's going to be what we would call in the trading markets a retracement of the equity markets. I mean, they've come back up sort of in reverse fashion. So that's the equity. On the rates market, bonds. Whoever couldn't make money in bonds. And so a couple things in bonds. Just the U.S. aggregate investment grade. So this is just investment grade bonds, treasuries, corporates, mortgages, asset backed, but all investment grade. In the last 12 months, March 31st, about 5%. High yield bonds, so these are non-investment grade, about 7.75%. Bank loans, about 7%. And some of these 1-year returns actually line up pretty well with yields and with our 10-year forecast on them, actually. That's just a coincidence, actually. But they kind of line up that way. So a couple of things, particularly on the ag. So the aggregate is really, as much as anything, a function of changes in interest rates. There's a credit component to that, but changes in interest rates, interest rates go up, bonds go down. It's really a function of that. The interesting thing, if you look at the Treasury yield curve and how that would impact the aggregate over the year, if you just looked at that yield curve right now, at least March 31st, and you superimposed what it was 1 year ago, it wasn't that interest rates came down across the curve. Actually, what we would call a twisting of the curve. So if you looked right out at 7 years, so you just take the Treasury duration, maturities of these Treasuries, and when you get to about 7 years, you look right there, and you superimpose those two, this year, last year, there's two yield curves, what you would see is everything 7 years in, interest rates went down. And everything 7 years out, that yield curve went up. And so, interest rates going up would naturally hurt. But in this case, just the way the structure of that index and the structure of that bond portfolio was more impacted by those shorter duration bonds and the longer. So it was just, if you're looking at that, it could seem unusual, but it was really, it was the part of the yield curve that was going down that impacted that bond portfolio. You've been using those three silos because PSF has material allocations.
Sorry, can I interrupt for a second?
Yeah,
Yeah, on the screen, I'm just seeing update on debt program May 22nd. Are you presenting a different slide?
so that's just the next presentation, Will. Mr. Hickman, that's it. Yeah, that's Red doesn't have any slides, and so that's just the next
Oh,
one.
okay. I thought there was a graph he was talking us through with the interest rates.
So, all right, thanks.
So that's enough on stocks and rates. And rates, I guess that's a nice segue into sort of part two to this, which is just a preamble. You're going to have one of your senior team captains here at John Hill over credit bonds, give you an update on the private credit portfolio that you approved as a new asset class February of last year. And it's up and running and making money, positively beating the index. So a couple of things, just I guess as an intro to that. So just as you've got stocks and bonds, and you've got public and private in the equity portfolio and the bond portfolio, you've always had sort of public, and within that public, you've had investment grade and non-investment grade. Newer to that is this idea of private credit. So private credit, it's been around forever in terms of some of the niche asset areas of that, like mezzanine finance or distressed debt. What's really happened post the great financial crisis, this idea of private credit just emerged. The banks really hadn't stepped in and were making loans in the way that corporate America really needed it. So the private markets stepped into that in a huge way. And I'll say in a huge way, just in the last 3 years, this part of the market has grown by about $500 billion per year, just in the last. So this is not only is it a larger part of the market now as an asset class, but its virtue has continued to grow. So it would just naturally make sense. I mean, a $60 billion fund is going to run around and try to invest anywhere it can to make money and diversify the portfolio. And this is an area you're looking and you're already beginning to make gains in. Some of the areas that you'll hear John talking about, are the mezzanine, the opportunistic credit, the direct lending. So these are some of the areas. Why NEBC brought this to staff and to the board more than a year ago, as we did to many of our clients. Again, you don't invest in any asset class for one of two reasons: either to increase the rate of return of the portfolio or decrease the risk of the total portfolio. In our own modeling, what we found was adding the private debt into the portfolio, best as I recall, did both. It added a measure of diversification, principally because of the way it's sort of priced in a lagged fashion, but also because of the additional yield. When I say additional yield, if we generally, for private equity and private debt, relative to the publics, we're going to have about 2 percentage point additional sort of expected return. Sure enough, if you look at those markets right now, there's about a 2 percentage point sort of expectation of that public comparable. And so that's why you do it. That's why you have been doing it. The good news is it's in now. There's still a lot of work to be done. It's already beginning to make gains and make money.
Questions for Red? Yeah.
Red, what are, for your view, just your clients or NEBC generally, what are the top 3 or 5 risks that people are positioning for over the next 6 months, 12 months, 2 years?
Yeah, I mean, with the uncertainty around tariffs right now, it's global, it's equities, U.S. equities specifically. And so we've changed in the near term this year some of our assumptions and some of our tilts. I'll give you an example of that. A staff would attest, we meet with them 2 or 3 times a month. We share what NEBC updates pretty regularly. We could start as tilts. So you should tilt your portfolio relative to your policy targets when we go. For the last year, our advice has been to sort of steer away from Magnificent Seven. In other words, the S&P 500, to try to take profits out of that, pare back, whatever, move into value, move into tips. I mean, there were 2 or 3 things we just felt like. And the last 3 months, just given the changes, we've neutralized like that tips stance for those that are worried about inflation still entering tips. We've neutralized that. Got a fair amount of clients that years had wanted to hedge inflation, and so that's one big risk right there. We think tips are up value. The other is that equity portfolio. While we still think, even though there's been a big tearing back of the Mag 7 and the S&P 500 and that growth index, we still think it's still broad. Some clients there, they have it to sort of rebalance, take profits or better to tilt away from that. And the good news is, and you've already heard your CEO, CIO speak to this, I don't want to say they're heeding our advice, but what they've been doing certainly coincides with the advice of our clients and those we've been sharing with them.
Further questions? Okay. And let the record show, by the way, and I failed to do this, Marissa Perez-Diaz and Will Hickman have joined us virtually, and so they are in the meeting. So, all right, with that, and with the setup here, we'd like to welcome John Newell and his team. And it's been the practice of this board to review at least one asset class each quarter, and this quarter we're looking at looking at debt, credit, the strategic partnership asset class. And Mr. Newell, how long have you been with the fund?
Gosh, over 10 years now.
10 years.
Since 2014.
And where's home originally?
San Diego.
San Diego. And graduated from
St. Mary's College in the Bay Area.
Okay. Pretty good. Well,
I moved here from Oklahoma. I don't know if that's a good thing in this. It's been a couple years in Tulsa. So,
as long as you were dipped forward.
yeah.
But welcome, and thank you for your good work, and we're looking forward to a great report on this and some insights. And so, Mr. Newell, if you'll take it away.
Perfect, great. Good to see you all again. It's been about a year. Again, I'm John Newell. I'm the vice president here at the PSF. I lead our debt program here. And I'm just going to spend the next couple minutes giving you an update on the overall program. We'll start off with the mission of the debt program. That's to generate excess returns over the benchmarks, prioritize income generation over total return, provide liquidity and portfolio diversification, enhance the PSF's cash flow profile, and very important to support the bond guarantee program. Came up about a year ago, talking to you all about private debt, private credit. We've showcased the team at that point. We've had one new addition to the team. That's Reed Spears. He joined us as a senior investment officer. He also joined us from Tulsa, Oklahoma. He worked for the George Kaiser family office there. It's a multi-billion-dollar family office. He brings a lot of investment chops to the team. He's already adding a ton of value in what we're doing here. So we're really excited to have him. Also important, you don't see it on this slide, we have extended an offer to another senior analyst. She has accepted. So she's hopefully going to start on June 2nd. We're really excited to have her. She joins us from a multi-billion-dollar multifamily office in Dallas, and she graduated from Texas A&M. Really excited to have her. And then we are hiring another intern on June 2nd. She will join us then, and then hopefully over the next 2 or 3 months, we'll bring on another intern. And so the team's going to grow from 5 people right now to hopefully 8. And so we're really excited about that. Got some really good people on the team. We're really excited. Slide shows the overall debt portfolio allocation. It's about a 28%. It's 28% of the overall policy target. The current allocation is 28.4%, so we're slightly overweight. I did want to highlight a few things on this table. You know, private credit with liquid substitute. If you recall, in the fourth quarter of last year, you know, private credit like PE and real estate, we make commitments, they draw down on that. It takes time to grow that allocation. So in order for us to get up to our policy target relatively quickly, we started that liquid substitute. And so we established a proxy for private credit, which is bank loans. So we've now gotten our allocation up to policy target. as private credit managers call more capital, we'll reduce that proxy and go more into what we call tier 2. We also do the same thing in private equity too. On this slide, I'll go through it real quickly. These are debt program benchmarks. We've got 6 underlying sub-asset classes essentially in this portfolio. Each has its own benchmark. That's very important for what we do. It helps us properly measure our investment performance and decision. I'll get into the meat of the presentation. That's the overall debt program overview. Page 7, I'm not going to spend too much time on this slide because we'll talk more about it as we go through the presentation. But since the first quarter of 2024, we chopped a lot of wood here. We've done a significant program restructuring. We've made a lot of investments and constructed a private credit portfolio that we're really excited about moving forward. We've also enacted on leadership's vision of the PSF Strategic Partnership Program, and we've established a number of mutually beneficial strategic partnerships across the PSF. Essentially, what we've done is we've laid the foundation for the past 12 to 15 months. We're really excited about what we've done here. I think we're set up really nicely to take advantage of volatility. We've got the right partners and we've got the right teammates too. So I'll just explain more on that as we move forward. Part of this whole kind of program is, debt is relevant again. Since the GFC in 2008, interest rates were very, very low. For about a 15-year period, it was, I think the ag, as Rhett was talked about earlier, the core ag was yielding about 2%. That's really, really low and tough for us to make money in that asset class. But given the most recent rate hiking cycle that we saw in 2022 and 2023, we're now able to source a number of different investments with debt investments with attractive all-in yields. And so what do? We updated our strategic asset allocation to do that. You can see here on this page that there's 3 new asset classes that we've added to the portfolio. That's bank loans, private credit, and also cash. We've removed some asset classes from here also, like EM debt and PSF treasuries. But really, we're able to now build a portfolio that we think can generate a very robust return stream, a very stable return stream. But if you look at those blue boxes, those are the value drivers of each of these asset classes, and they're relatively different. So we think that we can build a diversified portfolio that is structured very nicely. Next page. Touch on a little bit more about the diversified nature of the debt allocation. And what we've done here is we've compared the actual asset allocation from December 2023 to the current allocation in March of 2025. You'll see prior to the new SAA, 70% of the debt program was essentially invested in core fixed income and also long duration treasuries. Again, those were very low yielding asset classes. But the other big thing that created was it created a lot of interest rate risk. And so Rhett touched on interest rates and the volatility in the rates markets. If we kept that same allocation, we would have had a lot more volatility than what we've seen. As we added new investment asset classes to the debt program, we reduced core fixed to 32%. We removed long duration treasuries, so that 11% is now gone. We added more floating rate risk to the portfolio in private credit and bank loans. The important thing to understand here is everything that we do here in terms of allocating the new asset classes, it's with a focus on the bond guarantee program. So we want to make sure that we don't run afoul of anything that the rating agencies or anybody will have. In addition to having a relatively diversified debt program, we also think it's a risk balance program. As I talked about earlier, the floating rate versus fixed rate, it's about 50-50. Prior to the new SAA, it was about 100% fixed rate. It is 50-50 broken down between non-investment grade and investment grade. We think that that's actually a fine place to be. We're generating excess yields and excess returns, taking just a little bit more credit risk. And then a little bit more on the duration of the current portfolio. I'll just give you a couple stats. Prior to the new SAA and the new asset allocation, the public portfolio, which is essentially was essentially the whole portfolio in December of 2023. The duration on that portfolio was about 6.7 years. That duration now is about 3.85 years. So we've definitely reduced that interest rate risk, which we think is a very good, prudent thing to do given the rate volatility that we've seen. Also, by adding private credit, which is mostly floating rate, we've taken out the duration risk on that. Those private credit investments typically have a 3 to 4 year weighted average life, so it lines up relatively well with the from a risk standpoint with the I came up to you all last year, talked about private credit. We had private credit basically filtered across the PSF in a number of different teams, real estate, private equity, hedge funds, even fixed income was contemplating doing private credit. We made the pitch that we would like to bring that all under one team. We think that it would be managed a lot better, and we can understand that portfolio a lot better also with one team looking over it. We did the same exact thing with debt investments. So fixed income, credit, debt was being invested across fixed income, hedge funds, private equity, real estate. We put it all under one team in May of 2025. It creates a more efficient due diligence and investment and decision-making process. And it also improves our risk monitoring and our risk management framework. As one debt team, we have the ability to identify and act on risk a lot quicker than what we had in the past. Net all considerations for debt investments reside with one team. And now they're consistently applied across every investment that we make in this portfolio, and we hope it drives excess and better risk adjustment. Also on this slide, I don't want you to think that I want you to understand that we have one investment committee, and I think Jared's going to talk about this a little later. Even though we consolidated these debt investments under one team, we still are able to leverage the domain expertise from our real estate team, our private equity team, our hedge fund team, our equity team. And at that IC meeting, we all get to challenge each other. We all get to call each other out. Nothing is hidden here. It's a great place to basically leverage the expertise here at PSF. We think that's really important for what we do in the debt program. And we think that's important for the success of the program because debt investments typically touch all these assets. They touch real estate, private equity, there's public equities, debt is part of that capital structure. We just think it's great to be able to leverage our significant brain power that we have here at the PSF to help us make investments. Made over the past 12 to 15 months is we transitioned the internal fixed income program to an external fixed income program. What that did is a few things. One, and this is significant, it freed up a lot of talent here at the PSF to focus on higher excess return strategies that we would see in private credit, high yield, bank loans, and co-investments. I'll put it this way, we have 5 people on our team. Our external partners have hundreds, and we're all looking across the globe for attractive fixed income investments. So we consider that truly a force multiplier for the PSF. We're accomplishing more with the resources that we have, and it's generating significant returns in the core fixed income portfolio. So we're really excited. I know we presented private credit about a year ago. Just want to give you an update on that build out. We've done a lot of work. It's been a long year, but it's been a lot of fun. We've made a lot of investment. We've committed about $4.1 billion to private credit in 20 investment vehicles, and that's since January of 2024. As a reminder, that $4.1 billion will be drawn down over time over the next 3 to 4 years, so it's not all going out the door at once. About 60% of those investments were in commingled vehicles. So we're LPs, we invest with GPs, we're investing alongside other LPs in a fund vehicle. About 40% we've done in fund of ones, which are basically bespoke portfolios that we structure with the manager. So we leverage our size and our scale to basically set up a portfolio with the manager and utilizing their core competency, basically give us exposure that we would like to have at the PSF. So we're really excited about that. We've also started our co-investment program. So we've made about 5 co-investments. And as a reminder, co-investments are made alongside the GP. They bring it to us. We underwrite it with them. We passed on a number of co-investments too, but those are generally done at lower fees. So that's basically free alpha that we get from those investments. I'll touch on this later, but and Stu, I'm sure will touch on it too, but through this build out in private credit, we've also really established the vision for what the PSF considers a strategic partnership model. So we put 5 of them in the ground. We're really excited about that. They're already adding value, and I'll touch on it. For private credit, we'll focus a little bit more on that allocation because it's relatively new. We consider it a very defensive private credit allocation. It's about 50-50 broken down between investment grade and non-investment grade. We think that allocation, which mind you, is very different from how our peers do it. Most of what they do would be considered in that non-investment grade side. But we think we're getting paid for the risk and the attractive duration profile in the investment grade side. So we think that provides a significant stability to the private credit portfolio, given some of the uncertainties that we see. And we think it's very cool. Private investment grade versus public investment grade. Just want to reiterate why we like it here. And Rhett talked about it also. But in the private markets, we can typically pick up about 200 to 270 basis points of excess return over what we would see versus the public markets. And that's investment grade risk. Like these are big fortress-like companies, fortress-like balance sheets. They have scale, they've got pricing power, which is very important in this environment. We think it's a very good risk and we're getting excess yields from that. And it's been a rock solid part of what we've done so far. So that's the private investment grade versus public investment grade. On the next slide, we wanted to highlight just how that private investment grade portfolio looks. About 80% of that portfolio has some kind of asset collateral behind it. And we think that's very important. That's asset-based finance, that's commercial real estate credit, that's residential credit. 67% is actually truly asset-based finance. You can think about that as data centers, wireless towers. We're financing companies to build out a data center. The collateral behind that are the GPUs. It's the equipment that within that data center, and then they lease out that data center to the Microsofts or the Amazons of the world. So you get that cash flow from the corporation behind that, and that's some of the biggest companies or the biggest companies in the world, very highly rated from a credit standpoint. So we're really excited about that allocation, and we're getting paid excess yields in that, and it's very downside protected in any kind of stress scenario. So really excited. In the non-investment grade portfolio, it's a little bit different. We definitely have some more corporate risk in that portfolio. You'll see it's about 54%. When you think about that corporate risk, it's more sponsor-driven direct lending. That's what Rhett was talking about. Cash flow and covenants are the protection there. But still, we're getting paid excess yields in that bucket. So yes, we are taking a little bit more risk in the non-IG portfolio, but we're definitely getting compensated for that risk in that. Corporate strategies that you'll see in that portfolio are tech lending, middle market direct lending, and special situation. That's up now. And then important on this slide, though, is that even in the non-investment grade credit portfolio, private credit portfolio, we still have a number of strategies that rely on the asset collateral behind it. So we still think that there's a number of these, there's still a lot of defensive qualities in that portfolio that, again, we think will help us a lot given the uncertainty that we're seeing. Finally, on the last page, and maybe Stu can jump in after, but as part of this build out, we've established a number of strategic partnerships and acting on Stu and Bob's vision for that. We've created 5 of them. They're initially focused on credit, but some of these are with very large asset managers that span all asset classes, so multi-asset class. Some of them are with managers that have domain expertise in one specific part of the economy, we'll say. and that could be like residential credit. So really excited about that. They're all mutually beneficial strategic partnerships. So, our partners can leverage the PSF at $57 billion. They can leverage our size to help them launch either new vehicles or be anchors in funds that they're bringing to market again. We can leverage our size to basically start those fund of ones that I talked about. And we can tailor those portfolios and those risk profiles to how we want to structure the whole PSF from a risk standpoint. The important thing is that all of these are done at lower fees and good economics. So it's essentially a win-win for us, for our partners. And so we're really excited about that. Also, a really big important thing about these strategic partnerships is the knowledge transfer angle here. We've had a number of C-suite individuals come into the PSF and speak to all of us at the PSF, not just investments, but the whole PSF. You're seeing John Graves of the world. You're seeing, very, very successful people coming in and talking to us about, how they built their business, what's the most important thing to them. And it's just been great. It's been great for everybody at the PSF to get exposure to that. We've also had senior investment professionals, just one layer down from C-suite, come in and do teach-ins. Like, we understand we don't know everything. Like, we get that. A lot of those people know a lot more than we do, and they come in and they teach us about the next thing, the next big risk, the next big opportunity, and it's just been great. And again, even though it's been in debt, some of those investment professionals, when they come in, it's open to everybody at the PSF. So real estate can show up, natural resources, private equity can show up. It's all just increasing the knowledge and the skill set here at the PSF. So we're really excited about that. We also do a lot of co-investments with our strategic partners. And so that's, we've seen a lot more flow from them. And so finally, and Stu, did you want to talk to anything about strategic partners or?
No, I think you covered it. This is us recognizing we're a sophisticated investor with permanent capital, and we bring significant value to our partners. And in return, we expect significant value from them. And that's in both economic advantage and the breadth of investments we see. And in much softer areas, our head of HR here recently was in New York with our strategic partners, making sure she understood the best-in-class practices in HR and training. And we get very broad exposure from these partners. We make them work hard for us, and in return, we're good partners to them. And that is the nature of that. It also reduces complexity, reduced costs for us by having big partners that can deliver to us across asset classes, can go very deep, can go broad, and can support the entire enterprise.
And what I'm seeing here, because previously is that we kind of had a big fixed income team, right? And so this is a bit of a reorganization because bonds are debt. That's how corporations, how governments issue debt. But this is an expansion of that. And so we've really thought a little bit differently about, when you think about fixed income, and then we've really added, of course, we added the high yield, we added that as an asset class, but we've really expanded that a lot. And so, so we've really diversified that piece of the portfolio a lot.
Well, there's a lot more places to fish now. And so we're really excited about expanding that.
What are the top 2 or 3 shops?
We have several major partners on Wall Street. Because of the types of deals we strike with them and level of work, we generally don't talk about what they are, what they do. They're fiercely competitive. We're fiercely competitive, but they are big names where our scale and our expertise is valuable to them across different products.
Yeah, so sorry, go ahead.
No, go ahead and finish.
Yeah. So this is the final slide. Next steps. Really, hopefully, you understand that we've laid a pretty good foundation. Rhett talked on it earlier. I think we've got we've committed a lot of capital, but not all of it's drawn down. Those managers will draw down capital when there's volatility, when there's opportunity, and we see a lot of opportunity there. And we think we've got everything in place to kind of build this whole thing up. So we're really excited. And how do we do that? We leverage our strategic partnerships. We leverage our centralized investment process with that one IC that I was talking about, where we leverage everybody's knowledge here at the PSF. That's very important. And then attract, develop, and retain talent. We are hiring more people on our team. We're excited about those individuals. We want to make this one of the best places to work, not only in the state of Texas, but
I'm in risk mode today. So you mentioned strategic partners talking about what they think the next big risk is. How are y'all thinking about risks and implementing the portfolio sort of positioning for what you see as the biggest risks?
Yeah, no, I think a lot of that has to do with asset allocation. I think that investment grade private credit is a really good spot to be, especially in this environment. Having 50-50 split between that and non-investment grade, it's important. Again, those are in that investment grade portfolio. We've got significant asset collateral coverage. We've got significant cash flow coming in from the corporate borrowers. Those corporate borrowers are really, really big companies, and they're in growth mode. They've got huge balance sheets, they've got a lot of cash. So we think that those are pretty stable, durable yields that we're going to be getting. In the non-investment grade side, we've made a lot of commitments, but it hasn't all been called. So we're almost lucky to have that, because they can call capital in any kind of dislocation or in any kind of period of volatility. The legacy book that we have in the non-IG portfolio is a lot of it is in commercial real estate, and it's actually multifamily commercial real estate. And these are all basically a strategy where they're originating loans and flipping them into Fannie and Freddie Mae and taking securitization. So we think it's really good risk that underlines that. Have we had some volatility in our portfolio? Yeah, everyone has. Even on the public side, we've seen a lot of volatility. But we think we're in a pretty good spot here. We also don't have a ton of middle market direct lending. And so that's something we've kind of stayed away from since I've been here. I know I've been here for 10 years. I don't think we've ever done a middle market direct lending fund until last year. And we did one in Europe, which is fine because we're getting paid excess spread on that. But again, they've called 30% of that capital. And so we don't have any real legacy issues, especially with that 2021, 2022 vintage when private equity went on steroids and was borrowing left and right to do transactions. So we're really excited about that portfolio. And Brett and Bob talked about it also on the public side. We were overweight high yield. We reduced that. We were reducing that overweight beginning in the fall of last year. We're also overweight core fixed income. It had a duration of 6 on that portfolio. We took that down also. So we reduced our interest rate risk, we reduced our credit risk, and we've gone more to just being neutral to the benchmark. So that's how we're thinking.
Can I maybe add something just real quick? So our mission is to provide the best risk-adjusted returns we can for kids, pay those returns and distributions, and back bonds. And so some of the things that we've been working on together as a group is making sure that we have sufficient liquidity to maintain AAA credit rating, and a big project to create an implied credit rating model, see how much illiquidity we're willing to take, and make sure that we're being appropriately compensated for the risk that we're taking in private credit. As we've diversified the portfolio, it's actually reduced the likelihood from a probability perspective that we trip that 5A distribution. So the portfolio is slightly lower risk, slightly better return, and is able to continuously provide distributions on an ongoing basis. And so it's been a big project to make sure we're managing our illiquidity risk and our concentration risk. As the Mag 7 and the US became even more concentrated, we were adjusting our portfolios to make sure that we were able to satisfy those two missions.
We model if there's a economic slowdown, recession, something worse, do we model the underlying performance at the district level, i.e. the potential that we are actually called upon to guarantee a bond? Do we model that risk?
So we monitor that risk. So we do look through all of our underlying ISD exposures. We understand kind of what their current credit risk is. We do stress test and do scenario analysis for the fund. But I have not gone through and actually stress tested as individual ISD.
we probably have a little more exposure. Of course, an ISD is a governmental subdivision that has a tax base. We've been guaranteeing bonds since we guaranteed our first bond in spring of 1984. There's never been a default on those. Now, where you get into a little more risk is on charter schools that are not a governmental subdivision. But how that works is, we have a bond reserve. And so there's sort of a self-funded bond insurance program that they pay into. And so if there's a default there, then they're not made whole out of the fund, but out of another pool of money for that. That's a little bit. Did you have a question? No, go ahead.
John, thanks for your presentation. I know you and I have had several conversations over the past few months. Just want to make sure that the whole board hears about how we've implemented the decision that we made on private credit. If you go 15 months somewhere around there. As far as like we doing direct lending origination, I think on the spectrum of that all the way to investing with world-class managers into whether it's our own bespoke funds or commingled funds, kind of where have we kind of implemented on that spectrum?
Yeah, I mean, all of it, we don't do any kind of origination. Like we have 5 people, we can like that takes time. We work with our partners who do the origination on co-investments. They bring it to us after it's basically fully baked. If we want to go along for the ride with them, that's fine. We'll underwrite it with them. So it's no origination is being done by our own team. That's important. We don't have the skill set.
I appreciate that. That was a discussion point from a year ago when we were talking about this. So I want to make sure we asked the question. Thank you for.
For those listening that think they want a loan from the PSF, please do not call.
Yeah, right.
We are not in a loan business.
Probably not.
Investment business with world-class.
I think John, to that point, and I think that and what I'm listening to is that one of the things that we did is we were running that core bond program in house, and so I think that was really occupying a lot of our team's bandwidth in being engaged in tactical activities and not strategic activities. By closing that down and outsourcing that gives that team, your team, a lot more ability to really focus more on strategy and less on tactics. Is that fair?
Totally. Yeah. And look, there are very talented individuals on that team also. And, we joined our team. And so we're really excited to have them on. They add a ton of value. Yeah. And it's generating excess returns. And it's important, core fixed income, I think what we were trailing 10 years, delivered a one and change. Like it doesn't hit our bogey. For distribution. So really excited.
Well, I keep on hearing you say the word excited.
Yeah.
And you said it. I haven't kept a count, but I'm going to say it's somewhere between 8 and 10 or so, something like that. And so it sounds like that the junior team are really energized and you're loving what you're doing.
Yeah, no, I am, and it's fun to watch. It's fun to be a part of it. I've been here for 10 years. It's good. I think with the new leadership that we have here, it's pretty awesome. Like it's pretty great. So I think all of us are excited. We're all very busy, but we're doing interesting things, and it's fun to come into work. So.
Yeah, and Bob, I just wanted to make a point on that is that and it's my understanding that generally speaking, when you speak about excess returns and change and just in terms of return, 90 to 95% of that is an asset allocation. So can you kind of speak to that a little bit about just in terms of what we've done in the last year and kind of what the result of that has been?
Absolutely. So a year ago, or even when I was interviewing with John, I was asked by the board, if you were hired, what were some of the first recommendations that you would have? The lead was that we build a private credit program because the risk-adjusted returns that were available in the marketplace were just hugely diversifying, adding an additive to our portfolio. And in January of 2023, we approved a new asset allocation that, if you'll recall, in the old mix things, to put a fine point on it that Brett was alluding to, we were able to increase the expected rate of return on a magnitude of about 0.5 of 1% for no change in risk. Matter of fact, it was almost a minor reduction in risk. You don't get those kind of opportunities often. That's how powerful this was. But I can't underscore the accomplishment and impact over the last year. This core fixed income program that had been in place, we didn't bring all the team over. That was a chronically underperforming program, and indeed had some real compliance and cultural issues as well. As the folks that did not have the culture of compliance and effort are no longer employed here. That portfolio required $8 billion to be moved round trip. So $16 billion worth of money in motion that in February and March was accomplished by this private credit team as they just pulled together for the first time with the three of them. And when we announced that allocation change to add this private credit component, I remember distinctly reading in the blogosphere, some local blogger that will remain nameless. They said, well, that's a great idea. They scoffed at the notion that the PSF had the ability to implement anything like that. And here we are a year later, and $4.1 billion has been put on the ground in private credit. And why is that important? It's important. I'll show you, I skipped over this in my comments. The PSF was the third best performing large endowment in the country last year. And that's a stunning turnaround for this enterprise. There's many reasons for that. But when you look at the names that we outperformed, it's the who's who of endowments. You touch that asset allocation really drives that more than anything else. We're researching a lot of the subtleties of why. There's a multitude of reasons, but two of the biggest reasons are asset allocation. Our peers tended to have more in commercial real estate, which has been the falling knife over the last 24 months. All this office space that was almost overbuilt coming into the pandemic, emptied out, it's not refilling. And all of these were financed typically at 5-year terms. Originally, sub 3%. Now they have to refinance it, over 7%. And there's some significant markdowns happening in that space. And our peers tend to have more of that than we do. The other thing, though, instead of having that, what we have is more private credit. And that private credit that's adding 270 basis points over core fixed income is really adding to the mix. And the result of both of that is, we're the third highest plan last year. I would, as much as I'd like to say that this is where we're going to live from here on out, I can't, because this will be variable. But it's just illustrating the impact of all the changes that we have made. I want to mention something on risk, though, to address Mr. Wright's question. When I think about risk, the really big risk to this organization is the ability to live up to our mission to make these distributions. And that is driven on the expected return of our total portfolio. And when I look back over the last 30 or 40 years of what's driven returns, there was 4 major things. It was interest rates going from 15% to 0. And as they go down, the present value of every financial asset goes up. You had baby boomers entering into their savings era, buying stocks and bonds, putting money in 401ks, flood of money, stock prices. You had global trade borders opening up everywhere and providing many more market opportunities for trading. And then you had the internet that really was the lubricant of all that. Now, where are we going forward? Now we got rates, more likely to go up than down, and certainly we'll never get a 15% compression again. Baby boomers are in their required minimum distribution phase now, and the echo boomers are not as affluent and not pushing to near as much money in. I don't have to tell you about trade. We're closing borders, we're restricting that. It's going to be much more difficult. Yeah, while the internet has largely saturated our lives, there is kind of a 2.0 with AI. But in my estimation, 3.5 of those 4 forces are not the tailwinds for the next 30 years. It has been easy to make returns over the last 30 years by just having the 60-40 stock bond mix. Call it in and go to the beach and watch the 10% returns come in. I think what's going to happen in the next 30, 40 years, returns are going to be very, very muted across all asset classes. We will be lucky to put together portfolios that have, mid-single digit returns. And how do we, in that environment, try to keep growing our distributions to the NSF? There's really, only a couple of ways we can do that. We have to create value. We have to work in ways that you didn't really have to. These strategic partnerships do a couple of things. The most important is economics. Anytime we can squeeze costs out of the system, and these are expensive costs, that's up to many percentage points of your return. If you can squeeze that out, you get higher return for the exact same risk that you're taking. So that's number one. And number two is creating value through sweat equity, helping managers, create products, seeding them, owning, GP economics, looking across all of our managers. It's amazing to me that we have portfolio companies that could be doing business together, that could be synergistic with each other, but they're owned in different places. And if you can connect those dots, you can increase the value of both of those enterprises. That kind of activity, which is going to be very labor intensive, it takes talent. We're building out this, special situations, co-investment teams. That's how we're going to hopefully turn, a 5% return into a 7 or 8% return. That to me is the single biggest risk. It's not these little micro things that happen over the next year or 24 months. It's this seismic shift that returns are just going to be much, much lower than that.
So I'm glad you brought that up. So as I'm just listening to this, and I really appreciate a couple of us are in the private credit space, but so with your relationships that you have and with a lot of these top shops and the ability and like chart on page 16, the public versus the private credit and that delta, the ability to get in and be with these shops in various ways that's causing us to have that pop versus the up. And combined with the timing and the need for the cash flow generation and appreciation, that the balancing of all that. But with your access and also, as you mentioned, like with the banks backing up, private credit isn't going anywhere and there's still inefficiencies, but with your relationships, does it make sense? When I was looking at page 4, it looks like we're bumping up against maximum. Should we look at increasing some targets to possibly more?
The answer is yes, and we will. Because of that. What we were trying to do, we didn't want to create such drift from the policy by saying we'd like to be at 10%, and you're starting out day one at 0, and you've got such a mismatch.
Right.
So what I characterized the asset allocation, particularly in private equity and private credit, last year when we recommended to the board, that we were taking like half step towards what we ultimately think we'd want to be. And we made a lot of progress on that half step, a shocking amount of progress. Same goes for the private equity space. So we will be bringing that back to you. And it's an interesting, where I thought you were going to go with the question is, nature abhors a vacuum. And if it looks like there's this arbitrage, opportunity, will it go away? And certainly we're in competition. I mean, all these names on the list, we're all fighting for the same access, the same deals, the same capital. If you don't think so, I mean, we like to be collegial, we like to share information, but at the end of the day, we're competing. So having, relationships that give us a preferred status is very valuable to us. And, but most funds that are, everyone's realized private credit has been very attractive. But this is not just a trade and a security that just all kinds of money can go move into that trade and arbitrage account. There's such structural limitations. And on the really attractive side, there's only a few players that are of scale that can bring those kind of things to solution. Because, you know, these Fortune 500 companies, they want one lender to give them a unified solution. And sometimes those are $4 or $5 billion loans, and they need it structured in these three pieces, and it's got to be that way. There's only a handful that can do that. And we're partners with two of the top five.
I think that's the key point, because if you compare, because of the relationships and experience that you guys have, I think that's a differentiator for our fund. And it also happens to align with some of the requirements that we have in our fund that other funds don't. With, you know, it's permanent capital, but it also has distribution requirements. So it's a perfect storm. I mean, and it's a great opportunity the way, and I appreciate the way you guys are structuring these things, because I think we truly are getting incremental return per unit of risk above what others are getting because of your access and your structuring. So hopefully there's more room for us to be able to push more with some of these partners.
It's all about building this talent too, because it's just higher effort. You know, it's just, you got to roll your sleeves up and do a lot more due diligence. You have to know what you're doing, and that takes talent. And that's I think our single biggest challenge internally over the next 24, 36 months is recruiting and hiring. You know, we had an organization that had 100 people. We cut 20% of it to get, you know, only the right-minded people in here. But now we've got to grow it almost to the magnitude of, you know, 40+% increase. That is going to be critical. Who we hire and getting it right. You know, I've said it before, you know, divorce is painful and expensive, you know, but you get the right people in and the culture will continue to just supercharge itself. It'll become a self-fulfilling prophecy, but it's our single biggest challenge. That's where I think the internship program is a fantastic way to build young talent. You know, obviously we have to supplant that with some, you know, senior executives here or there and a couple mid-manager things. But I think the best way over the next 10 years, most of the talent will come organically through building a farm team.
Right. So just quickly developing on from Mr. Stanislaus's question around revisiting asset allocation. Historically, it's true. PSF revisited this every other year. And while it's true, NEBC doesn't like to see our clients get in a habit. You're not a global macro hedge fund. We don't want to see you get in a habit of trying to revisit this every 6 months or every 3 months. The truth is, you did this 15 months ago, and there has been a lot of water under the bridge since then. Externally, exogenously, and intimately here. We have the portfolio, all of the capital markets have just really, you know, changed quite a bit and evolved. And so sure enough, the investment team has come to NEBC a couple times now. Can we, what's the process? Can we look at this? And my point back is, sure, absolutely. The reason why we can. So you're hearing your CEO, CIO said, yeah, we've got plans to revisit asset allocation.
We've been able to tap into your organization's research team. Is that right?
Yeah, I think that's what they would say. They've gotten to know you guys pretty well.
Okay. Any other questions?
I had one, if I can jump in.
Yeah, Mr. Hickman?
Yeah, thank you. I just heard a while ago, like 100, 200 point basis spread between public and private credit. Can you just talk a little bit about, I assume these are not the private credit borrower. I'm assuming they're not investment grade rated entities. Kind of, can you talk about the borrower and why they're paying that much more and what we're taking on in risk in order to get that 100 to 200 point spread?
Yeah, you know, it's a lot of it has to do with speed. You know, the borrower would say it's like a data center developer. And they need capital to build a data center that they already have contracted out to a Microsoft or an Amazon. So your ultimate counterparty in that deal is some of the largest companies that you see in the world. So we would consider that investment grade. We consider the structure that we're lending to as collateralized by a lot of assets behind it. So not a lot of volatility in that, if any. And you're getting paid 200 basis points of spread on that because you're showing up with a $5 billion check. And that's what Bob is talking about. Where you can do it, you can do it quickly. You can do it, you have the skill set to basically structure a large deal like that within a few months. And the borrower is willing to pay that extra spread for that because there's certainty of close. And so it makes sense. And as the overall kind of weighted average cost of capital for that borrower, it's not really changing how much they're paying on interest.
Let me add a little finer point on it because, Mr. Hickman, that you said, the types of company, they are indeed in the investment grade portfolio, they are indeed the world's biggest investment grade companies. They're names that you would know immediately. And the spread pickup is between public and private for that same credit quality. So that's begs for how can that be? And the answer is what John's talking about, the ability for them to borrow significant amounts of money in the format they want quickly and without the cost of Wall Street and distributing it in a public market. We're the beneficiary of that because we have permanent capital, we have the expertise with our partners. We're not doing these directly, we're doing with partners. So that 200 basis point spread that otherwise might go to Wall Street, we pick up because we're quick, we're size, but it is indeed investment grade in that portfolio.
So quick follow-up if I can, is Microsoft the borrower for the data center or is the developer the borrower? And if the developer is the borrower, then does Microsoft provide a parent company guarantee?
Yes, they have contracted out for 25 years of cash flows for that lease income for the data center developer. That's just one concept. That's just data centers. But there's also there's large telecommunications companies that are investment grade rated that the collateral behind it is the backhaul services. Like it's all the network equipment. And they'll pay for that because they want to do some M&A somewhere else. And so they need to borrow some money. But they're investment grade rated counterparties and borrowers.
And then if it goes upside down, we own the data center?
Exactly. We have the collateral behind it, so we can take that collateral, we can enforce on it, we can sell it.
Okay, great. Thank you.
Good fulsome discussion and a lot of good things. And I tell you, and again, I think that when we think about that debt space and that we have this asset allocation, but we've even diversified underneath those within those asset classes. And I think that is really good work. So, okay. With that, if there's no further questions, we're going to move to our next board. We're going to take items 5 and 6 together because I think they kind of go together. And so what we've been working on is setting meeting dates and proposed meeting dates, but also too is that we're also kind of working on kind of creating a sort of a cadence. We know that there are certain things that happen at certain times at the year. And so we're sort of planning ahead, and then those recurring things that we can try to plan ahead on those things. And so Bob, why don't you go ahead and just take let's take item 5, and those are the meeting date for 2026.
Yes, Mr. Chairman. So when we set at their last meeting, we set the schedule for 2025. And in as much as the composition of this board is set for a biennium, it seems like there's no reason we wouldn't go ahead and try to set 2026 as well, just to help with advanced planning and everybody's calendar challenges. So we've proposed 2026 board meeting date. It's the almost exact same cadence. It's just these things are shifted by like a day just because of the calendar. Plus in planning, now the next 18 months or so. The other thing we're working on, what I'd like to end every meeting with, is kind of a preview of what is likely going to be on the next meeting agenda. Next time you see this, I'll have this calendar go all the way through 2026. but it's a way for us to see the cadence of like when the board's got to take on major things. But as you mentioned, when we brought in the whole fixed income debt team today, we have a rotating schedule that each quarterly meeting will have another asset class featured as well. You're going to have a cadence for when you have to take up the LAR, when we have to review audits, things like that. The preview for the next meeting is as follows. We'll have the real estate and real assets as the update, and potentially both ethics and governance policies, which we have been working on feverishly through committees over the last 2 quarters. So I just, if we could get a motion to approve those dates, that would be helpful. And then we have a motion.
I move that the board approve the following as the Texas PSF Corporation Board meeting dates for calendar year 2026. February 19, May 21st, August 20th, and December 3rd.
You heard the motion, and by the way, is that we've also assumed that the committee meetings would be the day before. Any discussion?
Mr. Chairman.
Yes.
My point was going to be on what you were just saying, which is less about the dates and where they fall in the calendar, but more structurally, because this is, I think, our second meeting to do the committee meetings the day before the board meeting. And so I think it'd be an appropriate time to figure out if that's working better or worse than the last model, which was a week prior. I don't necessarily have a viewpoint on it that I'm dug in on. Just this is our only chance to discuss that with staff and all the members of the board.
So the question on the floor is that I think that previously we had done committee meetings a week ago versus the day before. Does anybody have any thoughts on that? Just in terms of, I'm a little agnostic on it. I think we can do it either way.
Same way for our committee. It worked. The last 2 meetings, it worked the other way. I don't have an opinion either way either.
No, go ahead. I think the one thing I am noticing, and some of this is episodic, it's not necessarily the state of how these are going to go long term, but the committees have had a lot of work to do recently. And we're certainly filling that entire day. Having it a week earlier doesn't really change things, but there is notion, I guess, when we have some of these extraordinary workloads, kind of a watermelon through the snake thing we're doing. Conceivably, we may want to have 2 days of, so we don't, like, if we needed to, I might say we've got these committee dates and we might have one eye to say, conceivably, we may need to do the day before for one committee.
My comment on that is that I don't think it works well to do work and do a committee meeting in the same meeting, because one of those gets squeezed out unless you have 3 hours. Right. Unless if there's a big agenda item that requires discussion, you just can't predict how long that's going to take. And so I think when there are bigger topics, it might just be appropriate to pull them out, and that could either be using the week before, or if we switched them to the week before, using them the day before.
Okay, the work session.
Yeah, kind of a work session, just because when that happens, everything else kind of gets squeezed out.
Right, which we have made use of in the past, right? So we had this we could have this calendar, but if we know we've got, just a real heavy lift, there's nothing that stops a particular committee to say, 3 weeks before or in a month after or whatever, say we're going to hold a special purpose discussion on this topic so we can just get our arms around it more.
Well, I think we've got 2 things. We've got the overhaul of this, the ethics, and then we have the governance policy, and that's kind of a heavy lift because we've never had a governance manual before, and so we're creating that out of whole cloth. And so that's a little bit the heavier lift, and we're trying to get those. We've been kind of hammering around on those for a while, but my thought is that I'd rather get them right than get them fast. And so we're working really hard to get them right, and we might want between now and August we might want to have a work session And because I think our challenge is when we have everything on, and if we're going to do a deep dive, it's hard to do that with 3 committee meetings in one day. And I serve as a member or an ex officio member of all of them. And by the end of the day, you're ready to kind of, say, how effective that you can be with that. And so I think the answer is, I think we can probably keep what we're doing, but with the idea that if we know that we've got something like that, that's a pretty heavy lift, and there might, to your point, is that how effective is that to work versus meet, which those are related but not exactly the same. And I think the answer to that is that, well, 2 things can be true at once. And that is that sometimes on certain things, and I would say that the 2 things we're working on will probably, the best route to take on that is probably a separate work session ahead of that and get all of that hammered out. And then come back to our meeting.
I don't know what the protocol has been, but one thing that might free up some time, some of your guys' time, is if, there's a healthy amount of the same information that's in this board meeting that is that is also in the committee meetings. I mean, if we're going to hear it today, like yesterday, it's great to, hear it, but it could save a lot of their time too, not having to do some of the same materials in the presentation part. In the committee meetings the day before the board meeting, we're going to hear the same stuff. It just gives us a lot more time and frees some of their resources up as well.
I think some of this.
I'm sorry. And if I may, thank you. If I may, I also agree with that. I think that I think if we approach that sort of that redundancy in the way that it was just recommended, it also allows for us to hear any kind of conversation that, we're not privy to because we're not part of the other committee. So, it could be that some board members have the same questions or just the same concerns around something that's being presented that we might not all hear by not being in the same committee room versus having that information in one place with everyone in the room. So I would agree that perhaps we can lessen some of the time in the committee meetings by just sharing some of the information as a whole board versus in each committee.
One of the things that under the former construct, which I guess we did for a year and a half, 2 years, that I think if I was in your seat, Bob, I think it helps to have it ahead of time. There's time to recalibrate between the committee meeting or refine. Maybe that's the better way to say it. So there's a lot of feedback that we would give you during at least my committee meetings under the former construct that you could incorporate for the board meeting. And if I'm you and I just sat through 9 hours of committee meetings, you probably don't have a lot of time to turn that for the next day. You've got to make appointments. So the pro for the new way is we're all here already at the same time. So yeah, it does make it better. So there's pros and cons to each. I just wanted to have a conversation about it.
I think that is 2 kind of separate distinct forces, right? Let's say steady state and manageable little agendas. The fact that we're all together, it makes a lot of sense to have them, date back to back. Maybe even allow us some time, in between the evening of to do some more team building and, spending time together as a group. But separately, since we are literally this 180-year-old startup, we have some extraordinary projects in this first 2 to 3 years. That should not be the kind of thing we're having to tackle in years 4, 5, and 6. The heavy lift of building the first ever, comprehensive compensation plan. For the first time, we pulled together this budget and LAR. Those required special working sessions to digest. And I think we're seeing that same kind of pressure on these 2 big policy development items. And so if we can maybe pull those kind of extraordinary, I said the watermelon through the snake things out and treat them as different, or we might need either a working committee of the full board or a committee, what have you, to just digest that. but hopefully get to where on more, regular, non-extraordinary flows, this day before is not so loaded, it's not so taxing on everyone, and it has the benefit of if people are actually coming together to come to Austin, we're here to do both. So, combination of both of those things, depending on the particular thing. And we just have a lot of startup heavy lists that we're still working through.
Well, let's do this. We've got a motion on the floor. And the motion on the floor deals with the board meeting dates, which are those four. Let's do that. And I think that probably the prudent course of action would be then is to take the committee meeting dates as they come and just to depend on what they are. And maybe we'll go ahead and keep the date for cadence. And then, but if we have some other things that I think will take longer, that might require more staff time in terms of to prepare what was produced by that, then we'll take that as it comes.
Mr. Chairman,
Mr. Hickman.
are we on discussion on the motion?
Yeah.
So if I can tie these two topics together with a bow, I do like to be there in person. I do like a committee followed by the full board the next day. I was in Boston yesterday for my committee and I'm in Scotland today. And move out for me for college in Boston is every May 20th. So if I could offer a suggestion, either have that 2 weeks earlier or 2 weeks later, that would work well for me so I could be there in person in Austin at the building.
Mr. Hickman, are you offering an amendment?
Try discussion first. I'm happy to do that. I guess for discussion purposes, I'll just offer an amendment of 2 weeks earlier. So May 6th.
May 7th for board.
Oh, sure. Yeah, May 6th and May 7th.
Is there a second to the amendment?
Second.
The first strike amendment and a second. Any discussion on the amendment to go in 2 weeks earlier, which would put us about May 7th. Okay.
Just know that we've gone to the quarterly system for investment reporting and so forth. So just any feedback, I think we need to hear from staff on that, if that affect.
Yeah.
So the board official performance consultant is the Bank of New York Mellon. For them to provide a reconciliation of our monthly account and then combine our account to their broader accounts to create a peer universe, that process typically takes more than a month. And so if we were to have that meeting, 5 weeks after quarter end, we might struggle to get you some preliminary estimates, or we can give you, monthly account, but not the peer group. That would be a tight table. If you guys are comfortable with that, that's fine with me. But we might have to, depending on the timing of Boney's.
There's no mic.
Well, a week later, though, we start running up against, Memorial Day.
A week later.
Oh,
The 13th,
yeah.
yeah.
Yes. So, yeah. Okay. That'll work. And look, there's never gonna be like 1 month data that we really gotta, change, our strategies on or anything. We'll have preliminary data and it'll be reasonably accurate, but that would be helpful. We can do either.
Or would you like to?
I'd like to amend Member Hickman's amendment to the 1 week prior to the posted date.
Which is May 28th.
No,
May 14th.
May 14th, I'm sorry.
May 14th.
That's any better? Sound that don't present a problem. The second amendment is to amend the amendment striking 2 through 1. So it would be 1 week early, 2 weeks early. Second amendment. Second. All right. Any discussion on the second recommended? Mr. Hickman, does the 14th?
Yeah, yeah, that's great for me. Thank you. And I realize there's no perfect day.
Okay. All right. Any objection to the second recommended? Okay. No objection. Second recommended carries. The motion on the floor now is the first recommended to modify the main motion by adding, by striking the 21st and inserting the 14th. Any further discussion on the first recommended? Hearing none. Objection? No objection. Amendment carries. So we're back to the main motion, which as modified. Any further discussion on the main motion?
Okay, Chairman. Not so much about the board dates, but just as much as it applies to committee dates, which is the main motion, I think right now, to delete those out. Is that correct?
The committee dates were not part of the main motion.
Okay.
We've got some flexibility on that.
Okay.
So I think the big thing is let's just work with committee chairs and try to keep that. We just kind of go play the.
I think my only point I was going to make is we have a lot of really busy people in this, so we do need to get dates out. And so I look forward to working with you and everybody else to find something that works for everybody.
Right.
Obviously, we have a mission to do, but people's schedules book out 2-3 months.
So we're just going to have to be very intentional about moving forward and looking at what's going to be on that agenda. Okay. Those supporting the motion say aye.
Aye.
Those opposed say no. Ayes have it, motion carries. So we're okay. And yes, sir.
So one thing I'll note for the board, Mr. Borden mentioned we have a new GC joining. He's exceptional, highly experienced. We will want his input on these matters as we head into that August date. So I just note that he's not planning on joining until after the 4th of July. We have twisted his arm to get him to start working nights and weekends for us, but that will be a gating factor. Just we need that advice and we need that input. So as we plan the working sessions around these things, we'll have to consider that.
Okay, let's go to committee reports, and we've already kind of covered the meetings. Okay, Chairman Ryan.
Thank you. Budget and Compensation Committee met yesterday. It was myself, Chairman Maynard, Member Stanislaus. I'll go through quickly the details. We had remarks from the CEO that are largely consistent with what Bob covered earlier. We reviewed the board governance manual. Ariel gave an overview of the purpose, the history of the manual, as well as the committee charter and how those two interplay. And then substantive to the compensation process, Diana gave an overview of a new performance evaluation system, which is basically a quantum leap forward that kind of goes in tandem with the new compensation plan, but is a tool that all of the team will use to track performance, to give feedback, and really just a comprehensive talent management tool that looks like it'll be really important to the team. We also heard the legislative and bill tracking update, which was covered in the CEO remarks. And then similar to the performance evaluation system, we had an update on the budget and the budget process from Lucas Brandt, who's new to the team and has already built out some dashboards and a system to track the budget, make sure that we're staying in line, but also kind of being able to run sensitivities and again, kind of a quantum leap from what we had before, from Excel spreadsheets to a model that can look at all the ways that we can be efficient through the process. And then finally, we previewed the proposed agenda dates.
Any questions for Mr. Wright? I have any recommendations, we just, all right, Chairman Kinsey, strategic planning and policy.
Thank you, Chairman Maynard. The Strategic Planning and Policy Committee met yesterday at 2:36 p.m. It was myself, Chairman Maynard, Commissioner Buckingham, and Member Perez Diaz, so all were in attendance. Thank you to everybody for participating in that meeting. We heard very similar to what Mr. Wright just reported as far as the remarks from the CEO. Both of the policies we've been discussing today came through our committee, so R.L. Sloan took us through some of the high level on the ethics policy as well as the board governance manual. We'll continue to work those in the coming months as we've discussed. We also received a presentation from RL on the committee charters, which will be a part of this process, as well as we're reviewing and making sure all of these things sync together. And finally, Jared Stout gave us a presentation on the overview of the IPS as we started to think about how that weaves into these other policy decisions that we were making. So we talked about the purpose and the summary of the IPS, as well as the ongoing plan for asset allocation optimization and how the corporation will continue to improve on portfolio implementation. We ended the meeting with the same discussion as Mr. Wright's committee, talking about the agenda item, proposed agenda for the next committee meeting, as well as the calendar that we've just taken up in the last agenda item here. No action was taken, obviously, and we had no recommendations from the committee.
Chuck, have you, and you've been through the proposed ethics and governance manual?
I have been working with Ariel in terms of looking at those and providing feedback in the context. I haven't seen the latest drafts because they're still in working order, but we've been provided iterations of the draft moving forward and providing comment.
Yes, we also met yesterday at noon. We had Mr. Maynard, Mr. Thomas, Mr. Hickman, and myself. We also heard remarks from the CEO, similar to what we've heard today. Reviewed the ethics policy, and as we know that this policy is going through Mr. Kinsey's committee and our committee simultaneously. We went over the overall process of the updates and the summary of any substantive changes since our meeting last time. There were no requests from our committee for any further substantive changes at this time. We did an annual review of the committee charter. As we talked about a little bit earlier, the committee charter's idea is that it's a little more granular than the governance policy and the ethics policy. And I think the game plan is that we will end up adopting the committee charter at the same time that we do also the governance and ethics policy. We heard remarks and updates from our CAO, Mr. Garza. We had a couple things there. We had the SAO's office give a clean audit of the bond guarantee program, and they noted the amount of school district charter district bonds guaranteed by the PSF bond guarantee program was within the limits applicable to the program. We also had some internal audits. We had two new internal audits that were done, one related to the performance payment plan and one to the payroll process. The payment performance plan had one finding. Essentially is that was all done correctly, but the auditors want to make sure that the work was shown more specifically, and that will be tracked in the future. And then also on the payroll process, there was one observation that will also be tracked. They moved a few things on the audit plan moving forward, shuffled around a few of the dates specifically because of when KPMG would be starting their audit also. They informed us they posted a second FTE for the audit team, and KPMG will also present at the August meeting the annual conference of financial report for fiscal year ending August 31, 2025, and they have actually begun the audit for next year as of this month. Received the cybersecurity report. Quarter one, we had 100% completion on that. As of yesterday, we're over 50% completion for quarter two. And also discuss the security penetration test, both IT and physical, and those are going well also.
Everything I had to say is covered. All right. Any questions for Dr. Owens? folks, I think we're making good progress, and let's just keep going and making great returns, support public education, and to reduce borrowing costs for Texas taxpayers and keeping Texas great. Thank you all for your participation, and thank you for all that you do. And if there's no further business, this meeting is adjourned.